Hello everyone. We are now going to start a new topic. Give the heading Introduction to Financial Statement Modeling. Introduction to Financial Statement Modeling. Introduction to Financial Statement Modeling. Now, this is one of the most exciting and practical topics in the entire financial system, if you'll ask me. Okay, and just by the name financial modeling, okay, you might be thinking some complex modeling. Okay, it's going to be some excel heavy or some number crunching madness, but trust me, it is not. Okay, in fact, it is one of the most powerful tool you will learn as a future analyst, and now it is the part of the CFA program as well. Means after your exam you have to do the financial modeling portion before your results. Clear? Now, have you just giving you a base. Okay, so try to imagine what a company might look like after 3 years. Means you are in 2020 and you have started a new organization. How your company will be performing in 2023? Clear? That you want to know. Now, what is the purpose of knowing this? See, over here, if you'll invest your $100, then after 3 years, how much this particular company is capable enough to make it for you, and to identify that whether this is a good investment or not. Clear? So what you want to know, whether the sales will grow or not. Sales will grow or not. Okay, that is what you want to know. Clear? How much is the cost over the period of 3 years? Clear? Because sales minus cost, then only you will be able to come to your profits. So first you need to figure out how much is your sales, and then you need to figure out how much is your cost, so that you can arrive to the level of profits which you are making. Clear? Do you need to borrow the debt to manage your day-to-day expenses of the organization? Clear? If you borrow the money, then how you will manage it, how much interest you will be able to repay, that also very important. So all these things we actually do in a financial modeling. We model an organization, a company, that how it will operate after 2 years, 3 years, how it will generate the sales, how much it will be, cost structures, profits, cost of interest, debt, everything. Clear? So we are going to build a logical and a structured forecast of the future. Means how this company will perform in the future, that is going to be logical. It should not be random. So what we will do, we will start with the sales. We will build the income statements, we'll come up to the cost, and then we'll come to the profits. Then we will build the balance sheets, both assets and liabilities, and the third which we are going to build is a cash flow statement. But if you are forecasting something, you need to take the assumptions. Clear? So how we are going to start, we are going to start it with the 7 steps. Okay, now write down one by one that what we are going to do. We will start with the sales. Clear? Now, because everything flows from the revenue, first you will make the sales, then come to the cost, and then come to the profit. Clear? So how much you will sell in the next year, how much you will sell in the next year, next to next year, and what is actually driving the growth. Means you said that in your financial system, say 2020, 2021, 2022. Clear? Number of units sold, say 100, 120, and then 150. So over here your sale is increased by 20%. Clear? And over here your sale someone increased by say 25%. Just took a random number. Now you need to tell us that why you are expecting this much level of growth. Clear? What actually driving this growth? Clear? Then we will come to the second point. Once you have identified the sales, then you need to move to the cost. Now cost will involve the cost related to the goods which you are selling, the major cost, that is cost of goods sold. Clear? Then salary expenses and other overhead expenses. Clear? Based on how you are driving the revenue, sales and marketing expenses are there, depreciation expenses are there. Clear? After doing this, third, which we are going to forecast, is the financial cost and taxes. Financial cost and taxes. Clear? Because they are going to impact your balance sheet as well as the cash flow statements. Clear? Now, once we have calculated all these three things, sales, cost, taxes, okay, financial cost, which includes your interest expense as well. Clear? Now, we will see that the mistakes, okay, most importantly, the behavioral bias, okay, even professionals can also make the mistakes. Clear? Because it involves the assumption. So I make some assumption, you make some assumption. So we need to understand that there is a possibility of biasness. Clear? That we are going to study. So there are possibilities of biasness, most importantly the behavioral biases, because it's me who is preparing it. So there is a chances that my personal bias will come into the role. Clear? Then the next point is Porter's 5 forces. Porter's 5 forces. Clear? Basically, how strong or weak you are as compared to your competition, Clear? Then point number 6, which is very important, that is inflation or deflation. Inflation or deflation means the prices are rising, the prices are falling. Now this is a very important aspect. When I'm saying pricing or prices of a goods are rising and falling, try to understand in this way. 2020, 21, 22 units sold. Okay, let's say 100, say 120, and okay, rather than 120, let us make it 80 and then 60. Clear? These are the units sold. Now price, because of the inflation, price have increased. So over here we have the price of 10, then the price increased to 20, and then price increased to 40. So if you look at your revenue, okay, it is 1000, 1600, and then 2400. So can you see over here that my units sold have actually decreased? Inflation increase, this leads to my revenue increase. So if I will take my decision just based on the sales of that company, what I feel, that company is making good revenue, Clear? Sales is increasing, but in reality it's just the price which have increased the sales, but in reality the number of units which you sell, that is actually decreasing. Clear? So that's why we need to consider the inflation and deflation during our financial modeling. So what I'll do, I'll adjust my forecast when the input cost will rise or fall due to the inflation and deflation. Clear? This can also impact my sales as well as my raw material cost. Clear? And coming to the point number 7, like what is the forecast horizon? Means some forecasts for say 3 years, 5 years, 10 years or 15 years. For how many years you will actually forecast? Clear? So it is very important for the cyclical industries, because some industry, it happens that they have to follow the business cycle. Okay, those cycles are of 5 years, 8 years, 10 years, or some are even of 15 years. Clear? So these are the 7 points we are going to cover up in our lecture in a very detailed manner. Clear? Now the question is, why is this important? Why is this important? Means why are you doing this particular topic? Clear? Now see, in real world, Okay, I'm talking about the real world scenario where analysts actually build the stories about the company. Clear? Stories which can be backed by the numbers, logic, or even the good judgment. Clear? And you know the best part? Clear? Once you will master this, okay, you can look at any company. Means once you know how to do a financial modeling, in that situation you can look at any company, prepare the model, and you can say that where this particular company is going to be in the next 5 years, 10 years, even with the logic that, see, this is the reason behind I am saying that this company will reach over here after 10 years. Clear? So you will get a good idea how to build a model. Clear? How to compare it with a competitive organization, how to avoid the common behavioral biases. Clear? And you can forecast it in a very realistic manner, and it is very useful skill if I'll talk about equity research, portfolio management, or corporate finance. Clear? So I have given you an introductory session, like the purpose of doing this particular topic. But now from here onwards we will dig inside each and every LOS in detail. Clear? Now write down the first LOS which we have to cover up. LOS A. See, over here we have to develop a sales based performa company model. Okay, write down sales based pro forma company model. Company model. Clear? Now this is done in 8 steps. Okay. Now, first of all, this word pro forma. Okay. What is this? Write down projected or future looking, or future looking, projected or future looking. Clear? Now we are over here going to forecast the future financials of a company, means how the financial statements of this particular company looks like, whether it is income statement, whether it is balance sheets, or whether it is a cash flow statements. Clear? So we will start with the sales, and then we will build the rest of the income statement, balance sheet, and the cash flow statements. Clear? Now we will go step by step with a example. Okay, now imagine that you are analyzing a small tech company. Clear? And let's call it, say, Technova. Okay, Technova. Clear? And last year they have made a sales of $10 million. $10 million last year sales. Last year sales, how much? $10 million. Clear? Now you have done your research. Clear? Based on market trends, customer behaviors, competitors data, you believe that their sales will grow by 20% next year. Means after doing all the research, market trends, whether it is customer changing behavior, the data of the competitors, you believe that the sales will increase by 20%. Sales will increase by 20% next year. Clear? So now the step 1. What is the step 1? Step 1 is estimate the revenue growth. Estimate revenue growth. Now what you have to do? You have to estimate the revenue growth. So what was your sales last year? $10 million. Clear? And you are expecting the growth of 20%. So 1.20. 20% can be converted into 1.20. So what is your sales this year? What is the sales this year? $12 million. So this is your starting point. Clear? Everything will start flowing from here only. Clear? Then coming to step 2. Step 2. Write down estimate cost of goods sold. Estimate cost of goods sold. Clear? Now historically we have observed that the cost of goods sold is 60% of the sales. It is 60% of the sales. This is what we have observed historically. Clear? Now what is the new sales? $12 million. Clear? So what is the cost of goods sold? 0.60. How much? $7.2 million. $7.2 million. Clear? So now you have operating profit. Now you have operating profit, or you can say gross profit. Clear? Gross profit. Now step 3, you need to identify the expenses. You need to identify the expenses like selling expenses, which includes all your marketing and everything. Clear? Then we have general expenses, all the general expenses of the organization, and administrative expenses. Administrative expensive of the organization. Clear? Now in order to get the sales, in order to get the additional sales, clear, you need to make more expenses. You need to make more expenses. Means you have increased your sales by how much? $2 million. Clear? Now for that you have spent $20 extra. $20% extra. Means last year your expenses was $2 million. $2 million was your last year expenses. Now to achieve this higher sales, 20% you need to give extra. 20% you need to give extra. So how much it is to be? It is $0.4 million. So what is my total expenses? Previous 2 million plus 0.40, that is $2.4 million is my total selling, general and administrative expenses. Clear? I have this information from the last year, that is I have spent $2 million. Now I have to increase my sales from $10 million to $12 million. Now to achieve this higher sales, I have to spend 20% extra on selling, general and administrative expenses. So this is my new selling and general and administrative expenses. Clear? Now coming to point number 4. Step number 4 is about estimating the financing cost. Financing cost. You have borrowed the money and now you have to pay it. Clear? Now first of all I need to identify that how much money do I need to borrow. Okay, so one information I have from the previous year is that I have 1 million of debt. And on that I am paying 6%. That is $60,000 is my interest expense. Clear? But to achieve this higher sales, I will borrow more money. Clear? Suppose I have borrowed say $50,000 extra this year, $50,000 extra. Clear? Then I need to pay more interest, that is 30,000. So what is my this year total financing cost? $90,000. This is the financing cost of this year. Clear? Including the previous debt as well as the new debt. Clear? Now step number 5 is this is about estimating the income tax. Clear? How you will calculate the income tax? First you need to calculate the income. So $12 million was your sales, out of which $7.2 is your COGS, 2.4 is your selling, general and other administrative expenses, 0.90 is your financing cost. So what is your pre-tax income? Or you can say profit before tax. This is $2.31 million. Clear? Now the tax rate is 25%. So how much tax you are actually paying? This is the amount which you are paying in the form of tax. Clear? Now your income statement is complete. After that, step 6. you have to prepare the balance sheet. You have to prepare balance sheet. You have to prepare the balance sheet. Now you need to adjust all your working capital items first of all, like account receivables, inventories, payables. Clear? And if receivables are generally say 20% of the sales, means I am saying that my debtors are 20% of the sales, then how much it is going to be this year? It is 20% of $12 million, that is $2.4 million is your projected debtors for this particular year. Clear? Like this, you will identify all these elements based on your, say, suppose you are estimating the inventory and payables. So you can compare it based on your cost of goods sold, or you can compare it your historical averages as well. So choice is yours whether you will took it in the form of percentage or historical average. Clear? Then step 7. Step 7 is about estimating the capex. Write down estimating the capex. How much capital you are actually spending for the growth, for the purpose of growth. Clear? Suppose I say that I am going to spend $800,000 in the new equipments this year. So this is going to be my capex. This is going to be my capex. Are you clear? This is my capex. Now why I need this? To increase the sales. To increase the sales might be to increase the productivity. Clear? But now if you are doing a capex, then your depreciation expenses will increase. Then your depreciation expenses will increase. Are you getting the point? Now coming to the step 8. See, all the points are interlinked with each other. Okay, that you need to remember while you are framing your financial models. And the last point is to build the cash flow statements. You have to build the cash flow statements. Clear? So cash flow statements have 3 parts. Clear? Operating, investing and financing. Operating starts with the net income, then you add your depreciation, then subtract or increase your working capital based on the data, then subtract your capex which you have done, and add or subtract any financial cash flows, whether it is a new debt or the payment of the interest, or might be you have paid off the some portion of your debt as well. Clear? So this is how you are going to build your first financial models, and you can do it for any company. You can just pick up the company and start it, the process. Okay, from the very easiest manner. This is what we have covered up till now. Are you getting the point? Okay, so we have successfully completed our first LOS. Now moving to the second LOS, which is about the behavioral bias when you are forecasting. Okay, it is basically from the human's perspective. Clear? So second LOS, it is the biases. Clear? Now nothing related to the numbers, okay, but it is very important and generally overlooked by the humans. That is the human psychology. You heard me right, means you are doing financial modeling, no numbers, but still this is an important aspect. Clear? Now even in the world of finance where everything feels like formulas, ratios, data. Clear? But our brain can be our biggest blind spot. Clear? Now let me start with a question for you. Have you ever been so sure about something that you did not even bother to double check? Many times it happens. Clear? Now but later on you find out that it was wrong. Means you are so sure that it can't be wrong, but later on you figure out that yes, it was wrong. So this is what we call the behavioral bias. Clear? Now we will look into these biases in detail and how this can impact the forecast. Clear? Most importantly, how we can manage them. Clear? So we are going to cover up the 5 biases over here. So the first biases we will start with. Give the heading overconfidence bias. Overconfidence bias. Clear? See, this is the most common one. Even it can happen with you. You are very strong. You say that I am good with this topic. Means not even a single question can go wrong. That was your overconfident and that make you fail the exam by chance. I'm not saying that 100%, but what you do in overconfidence, you will not revise it. You will not revise it, and that will impact you negatively. Clear? Now you believe that your model is flawless. Clear? Your assumptions are way too solid and your forecast is gold. But in reality, it is not the case. Clear? Now imagine an analyst who actually predicts that Tesla stocks will rise by 40% in the next year based on their sales model, or you can say the profitability, the cost of goods sold. Also, you had the assumption that the input cost will go down, supply chain will improve, competition will be less, but it was a model prepared with overconfidence. Clear? That can go wrong and that might be wrong, but the point is how you can fix it. That's the important. Means if there is an overconfidence bias, how you can fix that? Number one is to use the scenario analysis. Scenario analysis. So what we have to do, we have to use the scenario analysis. Clear? So you have to build all possible scenarios rather than only this can happen. Anything can happen. Okay, input prices can go up, it can come down, competition can increase, new competition can come which can impact your sales, interest rates can go up which leads to higher financing cost, leads to lower profitability. All these things you have to consider. Clear? Now look at the past error. Look at the past error. Means the mistakes which you have made in your previous models. Clear? And ask yourself, is it necessary to be overconfident like this? I can be more sure by doing the scenario analysis. If based on after doing multiple scenarios, even if I'm reaching to that conclusion, then yes, it's good. Clear? Otherwise, I need to update the models. Clear? You can invite the feedbacks. You can invite feedbacks. Means you can ask some experts, some friends, some colleagues. Okay, might be you have missed something. Often better that you get it done from someone else, because there are so many things when you are doing a modeling, so many items. There is a possibility you might miss something. Clear? So just to overcome that, you can do a feedback. You can take a feedback from your colleagues or friends or some expert guidance. Clear? Now coming to your next bias, that is illusion of control bias. Write down illusion of control bias. Illusion of control bias. Now see, imagine you are an analyst and this is when I believe that I can control and predict more than I can actually. Means I can predict say only 60% of the financial statement accurately. Clear? But I believe that no, I can predict 98%. Clear? So it's more than what I can really do. So it's an illusion of myself. It's an illusion about my skills. Clear? So when you are doing an over engineered models, clear? So this error sometimes come into those models. What is this over engineered models? That I'll help you to understand. So what is this over engineered models? Basically a financial model, okay, that is very complex with too many inputs, assumptions and variables. Clear? Now it looks impressive. Clear? Means you have created a something disastrous. Clear? Something very big, but actually when you have so many things, it becomes difficult to prepare a model with accuracy. Clear? You have studied that even in the regression as well. If you have too many variables, it is sure that your model will not work properly and your R square will start going down. Your R square will start going down. Are you clear? So this illusion of control bias, clear? Write down. If you write these lines now, it will become much easier for you to remember. Okay, write down. This is when analyst this is when analysts believe, they can control, or predict, more than they really can, full stop. It often shows up in, over engineered models, clear. Now imagine that you are an analyst and you have built a forecasting model with 25 variables, okay, which includes the GDP growth, oil prices, exchange rate, and even the CEO's horoscope. Okay, now model looks impressive, but it is actually overfitted. It works with the historical data. But not working with the real world. Clear? So now how you can improve this bias? How you can actually improve this bias? That is important. Write down, focus on variables. Focus on variables with proven explanatory power. Focus on variables with proven explanatory power. Write down second, don't chase the complexity. Don't chase the complexity. Try to make your model as simple as possible. Clear? Sometimes less is more effective. Clear? These are the two ways you can control your bias of illusion of control. Clear? Now coming to the third bias. Write down, conservatism bias. Conservatism bias, or we also call it as an anchoring bias. Clear? Now see the anchoring. Anchoring means something you have actually hooked to. Okay, you have anchored something to. Clear? Means you have created a model using the variables. Clear? This is your model, and you are stick to it, and you are stick to your original forecasted model. Even the new information came in. Clear? But you are not incorporating that. Clear? Now let us say you are covering a retail stock and you have predicted 15% revenue growth. Clear? But then recession hits. Clear? That actually reduce the traffic to the markets, to the shops. Clear? And competitors have also launched their product better. Clear? Competitors have also launched their better products. So there are two setbacks to your output. One is your recession, and another one is the better product of the competitor. Better product of your competitors. Clear? Still you adjust your forecast to 12%. Still you say that okay, my revenue will increase by 12%, not 15%. Why? Because you are anchored to your original numbers. Still you are connected with what you have prepared before, so you don't want to make it downwards. Clear? Now how you can fix this? Particular bias? Write down, number one, use simpler model that are easier to update. Clear? Second, regularly review your forecast with a fresh eye. Now when I am saying fresh eye, why? Because if still you remember what happened in the past and still you are incorporating that, even after the changes in the market, the environment, the business, the new products, the technology, then your model will not give you the right number. Clear? And point number three, very important, don't be afraid to make big changes when situations wants. If situation wants you to make the changes in your financial model, you should make the changes. What's important for you? The right model. the right output of the model. Clear? Rather than your previous belief which have actually changed. Clear? Now coming to the fourth bias, that is representativeness bias. Representativeness bias. Clear? Basically this happens when we judge a situation based on superficial similarity to something else. Clear? Without looking at the actual probability or context. Means let me give you an example to help you to understand in much easier manner. Suppose you are an analyst and you see a new tech startup and think, oh, it's just like a early Amazon. Means a new startup and you are comparing it with an Amazon. So means this happens when, write down, first of all write down this line. This happens so that I can match the words by words with you. This happens when we judge a situation, when we judge a situation. This happens when we judge the situation based on superficial similarity, based on superficial similarity, superficial similarity. See the situation, you see a new startup, and superficial similarity, you say that this is a new Amazon. Means you have compared something very small with a something very big. Clear? Now you have actually ignored the fact that this new company operates in a very different regulatory environments. Clear? In a very might be having a very weak leadership, which Amazon have. How can you compare Amazon with something new startup without digging deep inside it, without seeing how it will perform? Because leadership, regulatory requirements, logistic infrastructure, all these things are very important. Clear? So you have actually ignored that. Clear? So what you need to do, you need to look at the actual context. You need to look at the actual context. Clear? Now the point is how you can fix this particular bias. Means you see Zomato and you will say that this is the new future of India, where it will become it will have the valuation just like the TCS or Reliance Industry. Might not be true at present, but yes, it is possible in the future. Okay, so don't compare something which is superficial. Compare it with the possibilities that okay, in the next 5 years here it can go. Clear? Now how you can fix it? Basically you need to have the inside view, company specific, that what Zomato is actually doing with the industry, that how this particular company is behaving or performing as compared to the industry. Basically you are comparing from a micro to a macro level, clear? And then check the base rate. Check the base rate means how it is actually similar to the companies who have actually succeeded. Clear? So we call this as a representative bias. Clear? Now coming to the next bias, that is confirmation bias. Give the heading confirmation bias. Confirmation bias. Now this one is little tricky. Basically you form an opinion over here. Okay, I have my opinion over here, then only I seek the information that supports it. Means I feel that today it will rain. Now I'll keep on searching on the internet something which can make my belief confirm that yes, there is a possibility of rain. So what I'll see, humidity, okay, ranging to 70 to 80%, high chances, high wind, okay, it's cloudy. Clear? Now I will ignore any other thing that actually challenge the view, Clear? So it's something like that. I love a particular stock. Clear? And I am very bullish on it. Clear? Then what I'll do, I read only those news which are giving the positive outlook. Clear? I will listen to the bullish podcast on that particular script. I'll talk to the people who agree with the point of view that this company will go rise. Clear? Negative news, I'll totally brush it off. Clear? I don't listen to these negative stuff because I have confirmed information that this stock will increase. I have all the details. We call this as a confirmation bias, where I have opinion and I believe this is correct. Clear? Now, how you can fix it? See, first of all, you have to intentionally read the report from other analysts who disagree with you and see on what points they disagree and see whether this point justified or not. Clear? Ask the colleagues for neutral, neither buy nor sell. Clear? Neither bullish nor bearish, to challenge your thesis, to challenge your opinion. Clear? Now, also evaluate the management commentary. What they are saying, are they also bullish, or it is the possibility that they are bearish but still I am bullish, that this stock will go increase? How it's come, how it is possible? Clear? So this is a confirmation bias. Clear? So we have covered all the 5 biases. So what I'll do, I'll keep this much in this lecture. I have covered the first 2 points of the particular topic, and the remaining I'll move ahead in the next lecture. Clear? Thank you.